Types of policies. Modified endowment contracts. In 1988, the Contract enacted the Technical and Miscellaneous Revenue Act, commonly referred to as TAMRA. Among other things, this is revised the tax law definition of life insurance contract. It was passed preliminary to discourage the sale and purchase of life insurance for investment purposes or as a tax shelter. By redefining life insurance, Congress effectively created a new class of insurance known as modified endowment contracts, or MECs. A modified endowment contract is considered to be a policy that is overfunded according to the IRS tables. For the producer who sells life insurance and the consumer who purchases life insurance, the significance of this is that a way life policies will be taxed if it is deemed MEC. Historically, life insurance has been granted very favorable tax treatment as shown in the following. Cash value accumulations are not taxed to the policy owner as they build insurance policies. Policy withdrawals are not taxed to the policy owner until the amount withdrawn exceeds the total amount the policy owner pays into the contract. Policy loans are not considered distributions and are not taxed to the policy owner unless or until a full policy surrender takes place, and then only to the extent that the distribution exceeds what was paid into the policy. However, for those policies that do not meet the specific test described below and consequently are considered MECs, the tax treatment is different. It is the policy owner who pays penalty taxes, 10% on premium distributions prior to age 59 and a half from modified endowments contracts. MECs normally apply to policy loans. Any gains received from a modified endowment contract, MEC, is included in the insured gross increase for the years, and 10% tax penalty is assessed on the gain if insured under the age of 59 and a half. How does life insurance policies become an MEC? More importantly, how does a policy avoid being classified as an MEC? It must meet what is known as the 7-pay test. The 7-pay test has nothing to do with the actual number of premium payments. Instead, it is a limitation on the total amount you can pay into your policy in the first 7 years of existence. The test is designed to discourage premium schedules that would result in paid up policies before the end of the 7-year period. If there is a material charge in the contract, the 7-pay test applies again. In addition to the basic types of life insurance policies, there are a number of special use policies that insurers offer. Many of these are combined or packages of different policy types designed to serve a variety of needs. Special use policies. Family plan policies. The family plan policy designed to insure all family members under one policy. Coverage is sold in units. For example, a typical plan could insure a family breadwinner for $20,000. The coverage on the spouse and children is level term insurance in the form of a rider. The spouse and children covered is usually convertible without evidence of insurability. Family income policies. A family income policy consists of both whole life and decreasing term insurance. This policy will provide monthly income to a beneficiary if death occurs during a specified period after date of purchase. The family income portion of this type of coverage is supplied by decreasing term policy. Income payments to the beneficiary begin when the insured dies and continues for the period specified in the policy, which is usually 10, 15, or 20 years from the date of policy issue, and not from the date of the insured's death. If insured dies after a specified period, only the face value whole life is paid to the beneficiary since decreasing term insurance expired. Family maintenance policy. A family maintenance policy consists of both whole life and level term insurance, which provides income for a specified period beginning on the date of death of the insured, provided the insured dies before predetermined time. This policy provides income to a beneficiary for a stated number of years from the date the insured dies. In addition, the beneficiary will receive the entire face amount whole life of the policy at the end of the income paying period. If an insured dies after the selected period has ended, however, the beneficiary receives only the face value amount whole life of the policy. Joint life policy. A joint life policy covers two or more people using some type of permanent insurance as opposed to term. It pays death benefits at the first insured death. The survivor then have the option of purchasing single individual policies without evidence of insurability. The premium for a joint life policy is less than the premium for separate multiple policies. The age of the insured are averaged and single premium charges for each life. Joint life and survival policies. A variation of joint life policy is the last survivor policy, also known as a second to die policy. This plan also covers 2 lives, but the benefit is paid upon the death of the last surviving insured. This type of coverage is sometimes referred to as survivalship life insurance policy. The insured and normally will cover 2 lives. As with joint life policy, the premiums for a survivorship life policy is lower than the combined premiums for separate life insurance policies on 2 individual survivorships. Life insurance policies are useful in estate planning because they can provide money to pay taxes on assets. Juvenile insurance. A juvenile life insurance policy is that insures the life of a minor. Applications for insurance and ownership of the policy retest with an adult which does not require the minor's consent, such a parent or guardian. The adult applicant is usually the premium payer as well until the child comes of age and is able to take over the payments. A payer provision is typically attached to the juvenile's policies and provides that in the event of death or disability of the adult premium payer, the premiums will be waived until the insured reaches a specific age such as 25 or until mature date of the contract, whichever comes first. Credit life insurance. Credit life insurance is designed to cover the life of a debtor and pay the amount due on a loan if the debtor dies before the loan is repaid. The beneficiary of such policies is usually the lender. The type of insurance used is decreasing term, which the term matches to the length of the loan period, that is usually limited to 10 years or less, and the decreasing insurance amount matches to the outstanding loan balance. Credit life is sometimes issued to individuals as single policies, but most often is sold to a bank or other lending institutions as group insurance that covers all of the institution borrowers. The cost of group credit life insurance is usually paid entirely by the borrower. Non-traditional life insurance. In the 1980s, insurance companies introduced a number of new policy forms, most of which are more flexible in design and provisions than their traditional counterparts. The most notable of these are interest-sensitive whole life, adjustable life, universal life, variable life, and variable universal life. Internet-sensitive whole life. Interest-sensitive whole life is characterized by premiums that vary to reflect the insurer's changing assumption with regard to its death, investment, and expense factors. However, interest-sensitive products also provide that the cash values may be greater than the guaranteed levels if the company's underlying death, investment, and expense assumptions are more favorable than expected. Policy owners will have two options: lower premiums or higher cash values. An interest-sensitive life insurance policy owner may be able to withdraw the policy cash value interest-free. The provisions that allow this is called partial surrender provisions. Underlying assumptions that could also turn out to be less favorable than anticipated would call for higher premiums than the policy issued. The policy owner may then either pay the higher premium or choose to reduce the policy face amount and continue to pay the same premium. Face amount plus cash value. A face amount plus cash value policy is a contract that promises to pay as at the insured death the face amount of the policy plus a sum equal to the policy's cash value. Adjustable life policies are distinguished by their flexibility that comes from combining term and permanent insurance into a single plan. The policy owner determines how much face amount protection is needed and how much premium policy owners want to pay. The insurance then selects the appropriate plan to meet those needed. Another option would be the policy owner may specify a desired plan and face amount. The insurer would then calculate the premium at final needs and object change. The policy owner can make adjustments to the change covered, such as increasing or decreasing the premium paying period or both, increasing or decreasing the face value premium period or both. Increasing the face value normally requires providing proof of insurability. Depending on the desired changes, the policy can be converted from term to whole life or from whole life to term. It can be converted from a high premium contract to lower premium or limited pay contract due to its design and flexibility adjustment. Life is usually more expensive than conventional term or whole life policies.